And traders at Access Bank say they expect improved bids in the Treasury bills market due to the enhanced level of money market liquidity. Liquidity rose by about 491 billion naira owing to FAAC credits by the central bank to banks. Ebube Uneze, team member, Treasury at Access Bank, joins us now for a market update. Ebube, it's good to have you on the program today. So we obviously have to start with the impact of those FAAC allocations credit. Tell us how that's impacted yields and what you think is likely to happen going into next week.
All right, thank you, David, for having me. So as you rightly noted, we saw improved liquidity in the system, going all the way from a repo of 21 billion to a liquidity position of 815 billion as a result of improved levels of liquidity from the FAAC inflows and coupon payments. As a result of these improved levels of liquidity in the system, we saw yields improve across the curve, both in the T-bills market and the bonds market. In the T-bills market, it's been a bullish trend as market participants, as the one-year T-bills is currently trading at about 10%. While on the bonds market, as a result of the last NTB auction results, we saw a lot of sell-offs by market participants. Consequently, the 2053 bonds are trading somewhere around 14.85% levels.
All right, let's talk a bit about the impact of the MPC decision. Clearly, they've adjusted the asymmetric corridor, but what I'm hearing is that the impact may not be very significant in terms of impacting liquidity. We do know that clearly banks would like to get a decent return by placing their money in the central bank, but what I'm told is that only a small amount of money is accepted by the central bank in that window.
Yes, David. Yes, Wale, you are very correct. The asymmetric corridor was narrowed from minus 100 plus 100 basis points to minus 700 basis points to plus 100 basis points to minus 200 basis points. Accordingly, we've seen the short end increase to 15.75%. So the implication of this is that banks can now place funds with the CBN at these elevated levels. However, there is a cap as to how much banks can place with the CBN at the SDF, as the standing deposit facility. So banks can only place a maximum of 2 billion with the central bank. So by and large, this will not have any significant impact in terms of system liquidity, as banks will still continue to place funds between themselves.
Of course, big news yesterday was the emergence of nominees for ministerial positions at the National Assembly. Did we see any impact of that in terms of sentiment in the market? What's your judgment of how the market is reading that finally we do have a list of nominees for ministers?
Well, I believe the market has been anticipating this market news for a while now, and thankfully the president was able to meet the 60-day timeline constitutionally set by our constitution. Most of the names that featured there are names that had already been expected, so we've not seen any adverse reaction to that news by market participants. So it's still too early to call, and we expect to see how things unfold going into next week.
All right, let's talk a bit about the exchange rate and the forex market. It didn't feature too much in the messaging from the MPC, but clearly it's a big issue. We've seen, I'm told it's not a unification of rates, but a harmonization of rates in the official market. That seems to have been significant, but not sufficient in terms of driving more investors to, or rather suppliers of dollars to bring their money to the table. What do you make of how the market has worked since those changes have been made?
Well, David, as you rightly pointed out, it's still a demand market. We still have a lot of demand vis-a-vis the supply of funds into the market. We've seen the I&E rates trend downwards from 792 levels at the start of the week to 768.08 naira to a dollar yesterday. Consequently, it's been the clamor of market participants that there should be an increase in yields in the T-bill space, and I believe that is one of the things that informed the decision of the DMO to increase the stop rates across the standard maturities at Wednesday's NTB auction. So we still expect to see yields at least increase in the short term to encourage foreign investors to bring in those foreign currency supply that we are earnestly looking out for.
Obviously, we can only play with estimates here, but what's your judgment of the quantum of this pent-up demand that clearly has to be addressed before we can really see the markets get back to normal, if you like?
Putting numbers to it, it's northward of about $3 to $4 billion pent-up demand in the system, both for matured forwards and current obligations.
Well, a lot of hard work for the authorities moving forward. We'll see how things play out. Thank you so much for your time today. I've been speaking to
Thank you for having me.
Uneze, team member, Treasury at Access Bank.